Hey, what's up, everyone? Matt Garland here, NMLS number 58700, but I'm better known as MG, the mortgage guy. Thank you guys for tuning into today's live video about student loans. But first, before I get into the video, all right, I want to give a big shout out to DJ MV, Flipping New Jersey, Earn Your Leisure, for these guys using their platforms to change the narrative within our community. So if you haven't been to any of DJ NV's or Flipping New Jersey's or Earn Your Leisure events, I'm going to put links in the description below. So we have Las Vegas coming up February 23rd for DJ NV and Caesar's Real Estate Seminar. Then also with Earn Your Leisure, we have the Earn Your Leisure experience happening in Atlanta January 25th and January 26th. So I'm going to put links below in the bottom so that way you guys can go ahead and check out those events. I will be speaking at both of these events. So hope I see you guys out in Atlanta in January and February, Las Vegas. All right. So let's get into today's episode. We're going to talk about student loans today. So this is one of the most frequently asked questions is folks who have student loans and they want to know how do you go about qualifying for a home when you have a tremendous amount of student loan debt. Now, these guidelines have changed over the last couple years. I don't remember the exact year that Fannie Mae, Freddie Mac, and FHA changed the guidelines. It had to probably be like 3 or 4 years ago, probably like 2015, 2016. But don't quote me on that because I don't know the exact date. But before, if the student loans were deferred and they were going to be deferred at least 12 months after we closed on the loan, then the student loan debt wouldn't be calculated into your debt to income ratio. But as we all know, that has changed and it makes it a little bit harder for folks who do have student loan debt to get qualified for loans. So the purpose of today's video and today's live is basically for me to tell you and explain the guidelines to you guys for conventional loans, Fannie Mae and Freddie Mac, and also for FHA. All right, so that's the whole purpose of this video today. So let's get to the first one, FHA loans, right? A lot of my borrowers and people that I speak to use FHA a lot because it allows you to do 3.5% down payment with no income restrictions. You can buy 1 to 4 family properties with FHA loans as long as they're owner occupied. 2 families to 4 families, then FHA will allow you to use their program to do that. But also FHA has the toughest guidelines when it comes to student loans. So let me break this down for you. So student loans with FHA, if they are deferred, right, they have to, we the lender, the underwriters, we have to use a 1% calculation of the balance, and we have to include that into your debt to income ratio. So easy numbers. If you have $100,000 student loan debt and it's deferred, then we have to use 1% as that payment, which would be $1,000 a month. That will be included into your debt to income ratio. Now, if you are in a IBR, which stands for income based repayment plan, if that income based repayment plan is not fully amortized payment, right? Meaning there's a term, there's an end to it, then we, the lender, still have to use 1% as your calculation because FHA will only allow us to use the payment if it's fully amortized. All right. So, what my advice, what I try to tell people is this: if you have to go FHA, if you have to go FHA, see what your payment would be if you had a fully amortized payment. And if you have a fully amortized payment with FHA and it's lower than the 1%, as long as it's fully amortized, then you can go ahead and you can use that payment. All right. Now, in most cases, from what I've seen, just with my own personal experience, if someone's is getting a fully amortized payment, depending on the balance of that student loan, they still may have a higher payment. All right. So now let's go into Freddie Mac. Freddie Mac guidelines, which Freddie Mac is also a conventional mortgage. All right. So Freddie Mac will tells us this: if the student loan is in a repayment, forbearance, or deferment, right? This is the eligibility in the document requirements. All right. If the monthly payment amount is greater than zero, use the monthly payment amount reported on a credit report or other filed documentation. Or if the monthly payment amount reported on a credit report is zero, then use a 0.5% of the outstanding balance as reported on the credit report. So let me break this down to you guys for you guys in layman's terms. So the first part, if it's in repayment, forbearance, or deferment, the first part of the guideline says if the payment amount is greater than zero on a credit report or on any income-based repayment plan that you give to a lender, the documentation that you give to a lender, if it's greater than zero, then we can use that payment with Freddie Mac. So let's just say your payment plan is $2 a month, right? And we have the proof from the IBR, which is the income payment repayment documentation, that shows that it's $2, then Freddie Mac will allow us to use that $2 to help you qualify. That will be included into your monthly debt to income ratio. Now, if you have an IBR, an income based repayment plan, that's $0 and it's reporting $0 on your credit report, then instead of using the full 1% like a FHA loan, we use a 0.5% to calculate what your monthly payment will be. So easy numbers again. If you have $100,000 in student loan debt, you are in an IBR and the payment says zero on your credit report, then we as a lender will have to use a 0.5% times 100K, which is your balance. That will make your payment $500 a month that the lender will have to use to underwrite your loan. My advice to you folks, if you're going conventional using a Freddie Mac loan program, get into an IBR payment which shows that you have a payment greater than $0. And then we can use that payment. All right. Now, there's a lot of loan forgivenesses, cancellation, and programs that employers may have. And Freddie Mac has some new language that's effective January 2nd of 2020, right? So they have new guidelines if you have a loan forgiveness program or loan cancellation program, employment contingency repayment programs, one of those things. Here's the new guidelines. It says the monthly payment amount may be excluded from the monthly DTI ratio, provided that the mortgage file contains documentation that includes the following. The student loan has 10 or less payments remaining until the full balance of the student loan is forgiven, canceled, discharged, or paid. Or the monthly payment on a student loan is deferred or is in forbearance, and the full balance of the student loan will be forgiven, canceled, discharged, or paid at the end of the deferment or forbearance period. All right. And the borrower currently meets the requirements for the student loan forgiveness, cancellation, discharge, and employment contingency repayment program, and the seller is not aware of the circumstances that will make the borrower ineligible for the future. All right. So the borrower is eligible or approved for the student loan forgiveness program, and this is effective January 2nd of 2020. So that was a lot I read, right? So I'm gonna just break this down in super layman terms for you guys. Basically, starting January 2nd of 2020, if you are in any kind of student loan forgiveness, cancellation, or discharge program, an employment contingency repayment program, and you can provide the documentation that proves this, and your student loan has at least 10 payments or left remaining until the full balance of the student loan is forgiven or canceled, you qualify for this portion of the program. So it could be excluded from your debt to income ratio. Or if the monthly payment on the student loan is deferred or in forbearance, and the full balance of the student loan will be forgiven at the end of the deferment or forbearance period, and you have the documentation to prove this, then your student loans can be excluded from your debt to income ratio. This to me is a home run for all you folks out there who have student loans and you are in one of these type of programs. Freddie Mac now will allow us to exclude that from your debt to income ratio. That is a home run for all the folks out there that have student loans and you're in those programs. All right, so make sure you have your documentation that can prove this too, because this is a new guideline and a lot of lenders are probably not paying attention to this right now. But I want you guys to be aware of this. So make sure you have your documentation. That's very important. All right. Now let's move on to Fannie Mae. Now, what Fannie Mae states about student loans is if a monthly payment, um, if a monthly student loan payment is provided on the credit report, the lender may use that amount for qualifying purposes. If the credit report does not reflect the current monthly payment, the lender may use the monthly payment that is on the student loan documentation, the most recent student loan statement, to see if the borrower could qualify. If the credit report does not provide a monthly payment for the student loan, or if the credit report shows $0 as the monthly payment, the lender must determine the qualifying monthly payment using one of the options below. So if you have so if the borrower is on an income-driven payment plan, IVR, the lender may obtain student loan documentation to verify the actual monthly payment is zero. The lender may then qualify the borrower with a zero payment. For the borrowers who have deferred student loans or loans that are in forbearance, then we have to use the 1% rule or get documentation showing the fully amortized payment in the loan repayment terms. But if it is zero, then we have to use the 1% calculation. So basically, let me break this down for you guys in layman terms. Again, if you are in the IBR program, all right, and we can verify it with the documentation that you are in the IBR and you have zero payment, Fannie Mae will allow us to use zero as the payment to qualify. If you are in a forbearance or your loans are deferred, then Fannie Mae says we have to use 1% as the payment. All right. So that was just, and I'm gonna keep it real with you guys. If I had student loans and if I was looking to purchase a home and I'm in the IBR, I would number one see what Freddie Mac programs that I qualify for, so that way I can use them, right? Because you're gonna have better options, especially because if you have to use a 1% calculation, that may be too much. So, at worst case scenario, if you don't want to get into IBR, if you want to keep them deferred on the forbearance plan or whatever you have, then you can use a half a point. And that's a lot cheaper than using a 1% with FHA or Fannie Mae. But I will recommend getting to an IBR. If you get into an IBR, just make sure you can qualify for a conventional mortgage, because if your IBR is zero, shows $0, then Fannie Mae will allow you to use it per the guidelines. And if you show a dollar or more with Freddie Mac, that's the number you can use for your debt to income ratio. All right. So I hope this information was helpful for you guys. I'm gonna answer a couple questions here that I see in the live chat. Uh, Okay, so Willie Miles wants me to check my DM on Instagram. Willie Miles, click the link in my bio, and I'm also going to put a link in my description here too. Book a consultation. Guys, my email and my DM are the matrix. The fastest way to get to me is click the link in my bio and on Instagram. And if you don't follow me on Instagram, MG the Mortgage Guy, or just the link in the description, you can book an appointment. You can apply directly for financing. You don't have to wait for me to respond to an email or a DM. Although I try my best to get to both of those as quickly as possible, but understand it's the matrix over there. There's a lot of people asking questions. All right. All right. So Larissa Muse says, what if you're going into a FHA with a partner that doesn't have any student loans. You got to be a little bit more specific. If they don't have student loans and you have student loans, then you can't, like, you don't just ignore the fact that you have student loans. You have to follow the FHA guidelines. If your student loans are deferred, or if you're not in a fully amortized payment, then we got to use the 1% calculation. All right. So Victoria Pruitt, what about for USDA rural loans? Good question. I don't do US. I don't do too many USDA rural loans. I don't really know the guidelines for student loans with the USDA, but I'll put a link in the description so that way you can, and I'll put the guidelines in the description. But I honestly don't know. I would assume that it follows suit with FHA because that's also a government backed program. So I'm going to assume that it follows the FHA guidelines, but I honestly don't know because I don't do too many of those loans. But I'll put the guidelines in the description for you. All right. What do you mean by the 1% calculation? So the 1% calculation basically means, all right. So let's just say, for example, what's your name? Scoops of Plenty. Scoops of Plenty. If you have 100K worth of student loans, and those student loans are deferred and you want to go with an FHA mortgage, then FHA uses 1% as the calculation of the balance. So we do 100,000 times 1%, and that would give us your student loan payment, which will be $1,000 a month. So that's how you kind of calculate it. Do you do conventional loans? Of course I do. I'm the mortgage guy. No problem, Victoria. All right, so should I do S corp or LLC for flips? All right, look, this video is about student loans. So if you don't have questions about student loans, don't ask me no questions, please. I'm trying to answer questions about student loans. Now, if you want to learn about LLCs, should you use an LLC or should you use a S corp? I have a video in my playlist. I think it's called playlist is free game. Go in there. I have a video with my CPA. We discuss LLC versus S Corp for real estate investors. It's about a 10-minute video. You'll hear directly from a CPA. What's the tax pros and cons for both situations? All right. All right. All right. So, what if you are a parent seeking an FHA loan, but you're a co-signer on your child's student loan? How would that affect the FHA loan? Same thing, Powers. It's the same thing. If those student loans are deferred, you see when you co-sign for your children's student loans, they're still your loans, right? You are legally obligated to those loans in case your child doesn't pay them back. They could come after you. So the same rules apply. It's student loans, they're in your name. If they're deferred, then we use 1% calculation and we include that into your debt to income ratio. So they don't give us any breaks because we are co-signed for our children or family member. So we still have to use the same guidelines, unfortunately. All right. So that's all I got for you guys today. I really wanted to come on here and kind of go through this student loan breakdown of the guidelines. So that way, going into 2020, you guys are fully aware of what's happening with student loans, how a lender is going to um, underwrite your loan if you have student loans. And right now, in my personal professional opinion, and this is just my personal professional opinion, Freddie Mac has the best guidelines for student loans. So if I had a tremendous amount of student loans that could possibly um, make my debt to income ratio too high to get approved for a FHA mortgage, I would look to see what Freddie Mac loans that you would qualify for and try to go that route. All right. So all right. See, Midwest Holdings. I have a video about that. You can go to that video. It's already in my playlist. I'm not even gonna bring that up right now. All right. So that's all I got for you guys. I hope everyone has a great weekend. Make sure you like this video, comment, subscribe, and then also hit the bell for notifications. I'm going to start going live, or putting up videos here on YouTube at least 3 to 4 times a week. I think this video will make number 2 this week, and I'm going to put another video out tomorrow as well. So make sure you guys are checked in with me. And also in the description, like I said, I'm gonna put links for I got a seminar I'm speaking at with Earn Your Leisure, January 25th and January 26th is the EYL ATL Weekend Experience. It's gonna be live podcasts, dinners, networking events, you name it, workshops. I mean, you name it. So I'm gonna put those links in the description below. And then February 23rd, I'll be in Vegas with DJ Envy and Flipping New Jersey for their seminar. And I have about 40 dates, 40 cities that I'm hitting in 2020. So as those dates get announced, be sure to look in descriptions of every video I put up because I'm going to put the information there. And make sure you guys follow me on Instagram, MG the Mortgage Guy, so that way you can stay aware and in the know of what's going on with my tour dates and things of that nature. All right. So, and if you have any questions, like I said in the beginning of this video, links will be in the descriptions for you to book a free consultation. And if you're past the stage of wanting a consultation and you just want to apply for financing, whether you're looking to refinance, whether you need a home equity line of credit, um, want to buy investment properties. And I have some amazing videos coming out with some of the tremendous investment property programs that I have. So I'm going to start putting those out probably in the beginning of 2020. But stay tuned for all of that. Below, click the links below. Click the links below. All right. So until next time, peace and love. I hope everybody has a great weekend, and make sure you check in tomorrow because I'm coming back here, YouTube, to drop another video. All right. Peace.